When you walk out of here, I want you to see the world in a different fashion. And I think the first thing is to understand it's not the strongest that survives, it's the one most adaptable to change. And change is coming faster and faster. And you can take change as a challenge or a threat, but you've got to accept it. Okay? Now, the big elephant in the room, thing governments skirt around, the thing which the IMF says will be 15 times worse than the GFC, is rising life expectancies. If you're a woman now under 50, odds on you'll make 90. If you're a guy, odds on 85. Now I'm telling you this to give you motivation to invest. Because if you've got no money, you'll be living on the pension, which is currently about $400 a week for a single and about 30 grand a year for a couple. And I put it to you that the pressure on governments mean those pension payments cannot be sustained. If a couple, the average person says, I've paid taxes all my life, I'm entitled to a pension. Well, if there was no government pension and a 65-year-old couple came to an advisor and said, could I buy an income stream indexed for life of $31,000 a year, they would have to hand over a lump sum of $600,000. Isn't that scary? And they're trying to say that they're only getting their taxes back. So basically, this is the first question. Now, this is a demographic chart. Notice that when you get right at the top, most of us males have died off. In 1946, we started to breed these people called baby boomers. And we bred baby boomers till 1964 when the pill came in. The oldest boomer is now 67. Their parents are about 87, 90, and their kids won't leave home and their parents won't die. Is that right? Absolutely. Now, just like a carpet snake swallowed a rat and the rat's moving through its body, that bulge is moving up, isn't it? So I can make you a perfect forecast. In 30 years, you'll be 30 years older. Yes? This is not a guess. In 30 years, the bulge will have moved up. That's a demographic map straight off the ABS website. It shows the growth in old people in 20 years. The old people are the light blue is what it was 20 years ago, and the dark is what it was in 2010. Notice how the old people are taking a bigger and bigger share of the population. See, what this means for you guys is if you're 50 and your parents are 70, 75, they might live to 100. And if you're 40, you're going to live to 110. Can you keep yourself for another 70 years? This is why it's so important to understand investment basics. It was called from pyramid to coffin. And back in 1925, very few people under 50. Now they're saying by the year 2045, it'll be this shape. And don't forget, the more people that get old and don't work, the more pressure on the taxpayers still working to pay for them. So this is the gathering crisis. Now, if you're a woman now, at age 50, a woman aged 50, they say you've got 36 years. But see, that's an average. It takes no account of medical advances in the next 30 years. So, this article in the May National Geographic is fascinating. They're talking about the way research is going on. There are some people with a disease and they can't grow. And they aren't dwarfs, they're just people who can't grow. They end up about as high as that. But the gene that stops them growing stops them getting cancer or diabetes. So when they isolate the gene that stops the little people growing, that'll have wiped out cancer and diabetes. So this is the kind of breakthroughs coming. It's been called the longevity tsunami. I mean, they're frantically trying to get products to match it. One product being mooted at the moment is that at 65 you might put a tenth of your super into a deferred annuity, which will pay you 10,000 index for life from 85 onwards, but if you die first you won't get it. There's all sorts of products coming. But the whole trouble with in the financial planning space, all these FOFA reforms have put so much work on compliance, the companies haven't had time for innovation. But hopefully FOFA's all bedded down and innovation will be the name of the game. Now this is scary. This is the average Aussie. A Brisbane bus driver gets paid $1,000 a week. They get paid about 52 grand a year. Last year there was a payroll glitch. And these guys who get paid $1,000 a week were paid 4 hours late. There was total chaos in the bus depot and all sorts of family crises. They actually hired armoured cars to deliver cash around the place. Now, how sad is it when you get $1,000 a week and you can't cope with being paid 4 hours late? But that's half the country. So we sort of face a future where half the country have got nothing. Half the country would rather do the football tips or buy lotto tickets. They have no idea of what is coming for them. Now, my mate David Williams has the My Longevity website. I urge you to visit it. It's free. If you're over 50, there's a test, and you can work out your life expectancy. And he says, so the tables are only historic. The tables are meaningless. It's like saying if you've got one leg in a bucket of boiling water and one in a bucket of iced water, on average you're lukewarm. They're nonsense. What David Williams says is life expectancy depends on 5 things. S is your situation. A good situation tends to live longer. H is health. Healthy people tend to live longer. A is attitude. Good attitude tends to live longer. P is parents. Good parents tend to live longer. And E is eating habits. So if you've got a bit of money and you're healthy, with good parents, a good attitude, and you eat well, you're more likely to live longer, aren't you? So this is, of course, don't forget that there's massive advances coming in all that. But over the top of that is our tax system, which is in frightful trouble. You imagine you're with Tony Abbott and Joe Hockey when Parliament meets next Tuesday, and you say, holy mackerel, our biggest growing group is the over 65s, but 85% do not pay any tax. Isn't that scary? Eh? So what do you do about that? Well, one is to put a tax on the family home and abolish stamp duty. I think that'll be very hard to run. Or raise the GST. Now, personally, I see no reason why we should not raise the GST and make it universal. I see no other way of getting out of this. But it's going to be a very tough ask. So that's a rather complex graph, and it's extremely complex, but basically it says that little thing at the bottom, what this really tells you is that a very small number of people pay most of the taxes. Okay, now, the next thing scary is our wage system. This is minimum wages around the world. We have the dearest wages in the world, the most rigid wage system. Remember when John Howard had work choices and all the furor it caused? This is why they're all outsourcing everything. You know, we're becoming a global village. Most things now can be outsourced, can't they? The big challenge universities have now is students can take courses online. You could go to Harvard online if you wanted to. The big challenge for universities now is students don't want to come to classes. They don't want to do this. They want to have it on a podcast or a webcast when they want to watch it. And this is interesting. Remember Julia Gillard, when the May budget came, spoke about Johnny? Remember that? And Johnny never got his bonus because he didn't get his bonus. Well, that was a nonsense, because that is the graph. Government income is the blue and government expenses are the red. Johnny did get his bonus, but he spent it before he got it. So don't let them tell you that income's falling, income's rising. They just can't keep their hands off it. Now, let's get on to the serious stuff, okay? Because I want you walking out of here determined to change your lives. Okay, how many legs can you see? How many legs? How many? How many legs? 5. How about you? 8. 8? 5? 6? I got no idea. You see, that's designed to show you what I think is the fundamental principle of wealth and health. The backbone, the tusks, the eyes, the tail are the unchanging fundamentals. The higher the return, the higher the risk. There's no such thing as a free lunch. If the phone rings with an investment opportunity, hang up. Hang up for sure, okay? It'll be a property spooker after you. But those legs, I mean, that's the tax rules, pension rules, and the markets, investment products. So basically, to become wealthy, you need to understand the basics, which I'll be talking about, and get guidance on the variables. And the biggest basic is compound interest. You've really got to get this. You've really got to get it. And basically this. How much money you have at the end of a period depends on the length of the term and the rates you can earn, okay? If the term is short, the rate don't matter. If you put away $1,000 a month for 2 years at 6%, you'll get $25,000. If you double the rate to 12%, you get $27,000. There's no difference, is there? The term is short, the rate is immaterial. But you go 30 years, at 6%, 1 million, at 12%, 4 million. And you think someone in this room who's 40, they've got 60 years ahead of them. Imagine the massive impact on your final portfolio of not getting a high enough return. It is massive, isn't it? So another lesson for you today is I've got to, on my portfolio, get the highest return I can cope with. Now, the rule of 72, you simply take that number and divide it by what you think your portfolio could earn. It tells you how long to double. Someone said, well, houses do 10% a year. Okay, well, take your house price now, and in 7 years double it, and 7 years double it again. And if you think that's right, buy houses. See what I mean? If your house is worth $500,000 now, and you think houses do 10% a year, it'll be $1 million in 7 years and $2 million in 14 years. But think about this. If a house really goes from $500,000 to $2 million in 14 years, where are wages going? And if wages are going at 10%, where's inflation going? If inflation's 11%, where are interest rates 14%? So it's a nonsense. Now, this is compounding in action. Every time, and don't worry about the 10. This is just mathematical stuff. I could have used 5, but 10's easy. Every 7 years, notice your money doubling. Can you see that? But every time your money doubles, there's more growth in the last double than all the other doubles added together. Can you see that? The next double would be 12 million, 24 million. But the trouble is, what happens if you start late? Can you see what happens? If you start late, you can't buy time, can you? You can't get any more time, can you? So the only way to catch up for most people is to go and rent some capital, and that's how most people catch up. So the average person, the only way they ever catch up is they borrow money, for good or for bad purposes. Now, if we now take it a step further, people say to me, should we pay off our home loan and then invest? To me, if you do that, you're wasting precious time, particularly if you've got a 30-year home on it. I believe the optimum house repayment is $12 $1,000 a month. That's every $100,000 you pay back $1,200. If you can do that, and I know it's a big payment, but if you can do that, there's no need to do it any quicker because increasing it any more will not help. I'll give you an example. Let's pretend there's two people. They've got a $200,000 house going and their neighbours and they're age 40. They're both paying back $2,400, which will pay it off in 10 years. This guy is very nervous. He gets in a panic. To chop the term to 5 years, he's got to increase the payments by $1,650 a month, which is probably $3,000 a month out of his pay packet in gross dollars. And all he does is cut the term by 5 years and save a lousy $38,000. If we go to his neighbour who leaves the house payments be, and he takes out a home equity loan for $400,000, and I'll pick that number, it's about the same price as an investment property, but because I like shares better, in this case we're going into an index fund that cannot go broke. You're not picking winners. Anybody can buy the index. And that cost him a tax-deductible $2,160 a month, interest only. So he's now controlling an extra $400,000 of compounding assets. Now, if we stay with him, at age 50, his house loan has just been paid off. Now, he knows, as we all know, if he does not invest those loan repayments, he doesn't need to make any more. They'll just get wasted, won't they? So he puts a bit of superannuation as a non-concessional contribution. And that should be that should give an extra $1 million in super at 65. So he gets to 65, house is paid off. He then withdraws $400,000 out of his super tax-free to pay his debt off. So he's now got an extra $600,000 in super, plus a $3 million share portfolio. Is that fair enough? Is that good? Say yes. That's exciting, isn't it? It's exciting. It's exciting. Now, if we go back to his mate at age 45, just paid off his debt, because he's starting 5 years later, if he wants $3 million at 65, he's got to borrow $500,000. He's got to borrow more. If he does, he gets to 65 with the $3 million portfolio, but he's got $500,000 to pay off, hasn't he? So he's now got to cash in about $1 million of his shares, less capital gains tax, to pay his loan off. Now, that's the power of compounding. Now, I now want to move to what I think is the most important thing I ever learnt. And if you can get this, it'll change your life. Are you all listening? Okay. We started, my journey of wealth and success started in 1974 when I read Napoleon Hill's Think and Grow Rich. And I went into partnership with a builder. For 10 years we built spec houses because he was a builder and I did the accounting and marketing and stuff. For 10 years we made a lot of money, had a lot of fun, paid a lot of tax, and occasionally couldn't sell a house. And we were forced to keep it. So we kept it and put in tenants. And at the end of our business partnership, all we had to show for 10 years of high income, high taxes, all the fun, were those houses that we were forced to keep. Isn't that amazing? If we would have sold everything on time, on budget, there would have been nothing to show for 10 years' work. And the lesson there is not buy houses. The lesson is we can always pay our commitments. I've got a friend who owns a restaurant, came to me 5 years ago saying, no, I'm making plenty of money, I'm not accumulating it. I said, righto, we're going to sign a direct debit now out of your bank account for the restaurant for $4,000 a month in a super for you and your wife. That's $2,000 each. He said, cannot do it. I said, look, just start doing it. There is no contract. If you can't do it, stop. So, 12 months passed. Gee, I'm doing it. Don't know how, but I'm doing it. 2 years later, well, I'm still doing it. About 5 years later, he's got $600,000 that had gone through his fingers. Because you always pay your bills, don't you? See, if his staff got a pay rise, he would have paid the bill, wouldn't he? See, superannuation like that is straight tax deductible, isn't it? You know. But I want to take you back for 130 years, and this is the best average return of a decade. So this is average return per annum per decade of the index. And the reason I picked the index is anybody can do it. I won't talk about the Magellan shares I bought for $1 and are now $12. Or the Xero shares I keep not buying because they keep going up 10% a day, and I keep thinking I've missed them. And I think, well, if I buy Xero, and they're out there now, these people, if I buy them, the run will stop. If I don't, it'll keep on going. So what we'll do is the deal. You all go and buy Xero shares, and I won't buy them, and they'll keep on going up. The moment I buy them, they will stop. Anyway. No, but anyone can buy the index. That's the negative years. So worst is 4. So if there's 4 negative years, how many positive years? 6. And that's the best year in return. 67, 55. And see, the average Aussie will only buy, normally what you have is a fall, then they panic, then the big thing back, then they buy, and they miss the good years, and that's the bad years. So the big message is, if you've got shares, you can buy, you've got shares, expect 4 bad years in every 10, but expect better good years than bad years. So that's the last 12 years. And I do submit that the Lehman Brothers crash was probably the worst in our lifetime. I think the bigger, not crash coming because of rising life expectancies, is going to come slowly. Like in Holland now, pensions have been cut by 1/3. I've got a friend who's a judge in Ireland. Their salaries have been cut by 1/4. Their pensions have been cut. So I don't think these rising life expectancies will mean a crash. I think the age pension won't be increased. They might raise the preservation age or something. They might raise pensionable age. But things are going to happen. Now, property spruikers. I made a vow in January I would wipe out the industry. I think it's like trying to abolish prostitution and slavery simultaneously. These property spruikers are making 50,000 cold calls a week. They're based on the Gold Coast, most of them. And the cold call normally goes something like, how would you like to pay your house off faster and save tax? And you say, yes. Are you aware the government is giving special incentives to invest in real estate? Well, to see if you qualify for the government assistance to buy real estate, are you free Thursday or Friday night? When they qualify, you've got an equity in your home and an income, you get taken a bundle for the 6-hour brainwash interview. And they give you all the life expectancy stuff, which is true. And they say you can't trust shares, look at Babcock and Brown, ABC Learning, da-da-da-da-da. You can't trust superannuation, you can trust bricks and mortar. But how do you find it? We will find it for you. And to save you money on stamp duty, we will build it for you. Then you say wacko, right? And why do you think they want the building contract? Because under Queensland law, you need a PAMD 27C to disclose the hidden fees, but not on a building contract. So when they stick their $60,000 hidden fee on top, it stays hidden. Isn't that amazing? And the whole essence of them is that you buy the investment property and use the income from that to pay your home loan down and capitalise the interest on the investment property loan, which means you're now stuck with an overpriced property at the back of Burke, like Caboolture or Stranthorpe or somewhere like that, Strathpine, with the debt rising. Now, the tax office are opposed to it. I talk to the tax office regularly. I've sent the tax office a list of the spruikers and said, here's the spruikers, audit their clients. You will make a fortune. Tax office are very interested, all right? Because you cannot capitalise the interest on an investment property to pay your home loan off faster. So we're working on it. It's a long, long job, but that's what we're doing. Now, so I think, we are getting traction on this. They then move to self-managed super funds. Because you see, this is what people think. The market falls. Most superannuation funds invest in shares because shares give the best long-term returns. If the share market falls, superannuation funds fall, don't they? Front page newspaper. Joe Bloggs says, I could have done better myself on those bastards in Sydney, taken all the fees out of there. So they are then encouraged to start their own fund. Now, ASIC issued a warning yesterday. This is in the Fin Review this morning. The text of that article was the advice was not sufficiently tailored. There was inadequate or no disclosure on what else they could have done. There were no insurance recommendations. They were pushing an inappropriate single asset class. There were no alternatives to self-managed funds were thought about. Inadequate consideration of their long-term planning objectives. And notably, investors were not warned if you've got a self-managed fund, there is no statutory compensation in the event of fraud, as in Trio. The Trio investors in retail funds got their money back, self-managed funds did not. Now, so I really think, I've got my own fund. I think your own fund's great for the right person, if you've got a great track record in direct shares. If you want to hold your business premises in it. If you're silly enough to invest in artwork, which is worse than, well, artwork's, I think it's a terrible investment, or option trading, which is worse. Anybody option trading? Well, don't, all right? It's good until it stops being good, then you're in big trouble. Anyway, the reasons not to is you reckon you can do better than everybody else. I mean, I always find it amazing that guys with no experience at all think they're better stock pickers than guys that do it full time. That's why most of my money is in managed funds, because they pick them better than I can. You were talked into it by a spruiker to gear into property. I mean, to me, if you want to gear into property, why wouldn't you do it personally? There's a basic tax benefit principle. You take the benefit today. Why would I want to gear in a 15% tax environment, but I can gear in a 46.5? And you need to be detail-minded. Are you aware of the penalties for having a non-complying fund? 46.5% of the taxable component last June. So your fund has $2 million of assets, $1 million is taxable, $1 million is non-taxable. A non-complying fund, $465,000 is the penalty.